Alright guys, so today I'm going to talk about a recent futures trade that caught my attention due to its high probability aspect. Now I'll try to break this trade down for you, giving you a clear picture and some key takeaways. So let's cut to the chase and get started. Now we know that no two trades are identical. Obviously the outcomes can vary. It could be a win or a loss. So I think it's key to stay alert and understand how different trades work. And what I mean by that is that you have to look at this in terms of how they are structured and how that structure helps you identify high probability entries. For this specific long trade, let's kick off with a 3-minute chart. Now, this time frame, in conjunction obviously with higher time frames, provides us with a solid base to analyze the market and then forecast the imminent trends. Keep in mind, guys, that price action traders have, I think, a unique advantage here. The reason for that is because knowing or having a grasp on the market's current phase in relation, obviously, to the Wyckoff cycle allows us as traders to align ourselves with its rhythm and make informed guesses about the market's bias or its future direction. This understanding, however, is not enough on its own. I think it needs to be complemented in order for it to work. Obviously, it needs to be complemented with a view of the broader market sentiment. In other words, there needs to be a harmonious balance between short-term signals within your point of interest, in my case, this specific area over here, and the larger market sentiment. I think that this balanced perspective can help you as a trader make better entries and possibly increase your chances of green trades. And this is exactly what we've got here with this bearish sentiment depletion. And now I understand that some of you viewing this video may question, well, Undercurrent, how can you argue for a bearish sentiment exhaustion when the bias seems lower? To that fair question, my short answer would be the trend appears to be downward until you recognize the balance I previously mentioned between short-term signals within the area of interest and the broader market sentiment. To be more specific, the first possible signal I got within my area of interest was the price reaching the top of the consolidation phase. This phase, as the initial stage of this already completed Wyckoff cycle, served in my view as a clear support level. Obviously, we can see the market attaining some good price equilibrium here through this whole bearish action that started with this triple top action up here. Additionally, the downtrend hold move was further, I think, reinforced through an upward breakout in this 3-minute descending channel over here. And again here, guys, you might be wondering about the difference between these two seemingly identical mini reversals and why I go into this one as opposed to this one. From my perspective, the difference I think lies in the structure of this consolidation phase and consequently the transformation of this resistance level into a support level. These levels, as you already know, often indicate that selling has been overcome by buying, clearly a dynamic, often leading to an upward price trend. On the other hand, at the upper point here, we are dealing with a weaker probability of support. Had I decided to pull the trigger at this level, it could have easily broken, just as it obviously did down here. And now, as we move to the execution part of the trade, after getting filled and seeing the trade go my way, I was in a position where I could have let it run. I had pretty much the bottom buy of the mini range here, so I could have let this run all the way to the top of this imbalance area, as it eventually did after I closed the trade. Obviously, that would have been a solid scalp. However, the issue with this approach was the low liquidity environment. Being in a low liquidity market can be a double-edged sword. On one hand, it could lead to increased volatility, providing opportunities for high returns. On the other hand, it's very easy to be blown out due to this same volatility. The reason behind this is quite simple. In a market where there is a lack of liquidity, it only takes one significant player to start making moves. Because there isn't enough liquidity to counteract their actions, this can trigger a substantial upward or downward movement. Such movements often lead to the activation of many stop orders, creating a domino effect. This can significantly amplify the original price movement, causing abrupt and drastic price changes. It's like being basically in a small boat on a big ocean. One large wave can easily capsize you if you're not prepared. So rather than risking my trade, I decided to take the profit and stay out of the market until things stabilized. I believe that trading is fundamentally about smart risk-taking. It requires, and this is particularly important for those new to day trading, it requires a strong emotional detachment from your trades. When a trade starts to go your way or against you, having the clarity to cut your losses without hesitation or not let greed cloud your judgment is crucial. Often traders lose more money because they simply don't want to admit they made a mistake. That's why I think that it's a must to analyze risk with a level-headed and an unemotional mindset. And obviously unemotional is the key word here. It's all about state of mind management, guys. That's where the true essence of trading lies. Now, if you are interested in delving deeper into price action trading, I recommend watching this next video here. All right, guys, that should do it for today. Thanks for watching, and as always, catch you all in the next one.